Warren, how would you define true success?
Well, I've said many times that if you get to be 65 or 70.
Don't wait to start if you want to be as wealthy as Warren Buffett. When asked how to make $30 billion, which was roughly his net wealth at the time, Buffett gave this advice in 1999 at Berkshire Hathaway's annual shareholders meeting. Buffett, who is now worth more than $100 billion, said compound interest is an investor's best friend and compared growing money through interest to rolling a snowball down a hill. When he was 68 years old, Buffett advised, start early. Want to know more? Keep watching. I began constructing this small snowball at the top of a long slope. To have a really long slope, you must either start young or live to be very old. If he were graduating from college in 1999 and had $10,000 to invest, the Oracle of Omaha said he would be strategic about where he invested his money. I would probably focus on smaller companies because I would be working with lesser sums and there is a greater potential that something would be neglected in that field, Buffett remarked, adding that he would begin by looking at companies alphabetically and work his way up. When looking for promising businesses to invest in, investors, according to Buffett, must fend for themselves and rely on their own expertise and intuition. He went on to say that wise investors should understand what you know and what you don't know and act extremely forceful when they find a good opportunity. When it comes to investing, Buffett says you can't search around for individuals who agree with you. It's impossible to find anyone who knows what you're talking about. On the other hand, Buffett is a strong fan of index funds, which own all of the stocks in an index and are thus automatically diversified. In 2017, Buffett advised investors to consistently buy an S&P 500 low-cost index fund to grow wealth. Buy it through thick and thin, and especially through thin, says the narrator. Nonetheless, Buffett has claimed that aiming for $30 billion is pointless and that the amount of his money is incomprehensible. After a moderate level, the money makes very little difference. He remarked, if you ask me to take away a big percentage of my net worth for a few extra years of my life or the ability to do whatever I want during those years, I'd do it in a second, he stated. On Saturday, 2 episodes featuring Warren Buffett and Charlie Munger kicked off Berkshire Hathaway's annual shareholder meeting. Then there was the video of Munger laboring feverishly to open a box of See's Candies peanut brittle. There was a box of brittle waiting for the 94-year-old Munger when the movie ended, and both took the stage in front of a crowd of over 20,000 at the CenturyLink Center in Omaha, Nebraska. Buffett started into a time-tested investing anecdote as Munger munched away and broke open can after can of Coca-Cola. He held out a 1942 edition of the New York Times when the war's conclusion was still up in the air. The famed investor made his first stock purchase at the time, purchasing a few shares of a company called City Service. Following that, the stock dropped by nearly a third before recovering. Buffett sold his investment for a tiny profit after becoming concerned about the stock market's inherent volatility. Of course, the anecdote was a setup for Buffett's main investing principle, the power of compounding. His ownership would now be worth $400,000 if he invested the $114 he spent for City Service shares in the S&P 500 in 1942 and then done nothing. Buffett told his audience that $10,000 invested in the S&P 500 index would be worth $51 million today. The annual meeting of Berkshire Hathaway shareholders can generate a lot of press. Buffett revealed why he'd switched course and become a major shareholder in airlines like United, Delta, American, and Southwest a few years ago, his remarks are still the best argument for the now consolidated industry. People expect Buffett to reveal how Berkshire would spend its $100 billion in cash at his annual meeting, but Oracle has yet to make an acquisition. Buffett's unwavering backing for scandal-plagued Wells Fargo and its turnaround CEO, Tim Sloan, made headlines this year. Buffett of Wells stated, "I like it as an investment. Berkshire Hathaway is the bank's biggest shareholder. As a manager, I admire Tim Sloan. He's rectifying other people's mistakes. What's the takeaway? Expect little selling pressure from Berkshire Hathaway in Wells." Are there any other revealing items? Duracell, a company Berkshire acquired in a deal with Procter & Gamble, has struggled. A significant amount of money is being invested in boosting earnings. Buffett also dismissed the idea that Berkshire will ever issue a special dividend by distributing its vast cash reserves to shareholders. If it were put to the vote, shareholders would back Berkshire's current approach of investing surplus cash, which has yielded strong returns. Buffett praised Apple, Berkshire's recent significant investment, for its simplicity and management's readiness to return capital to investors. In terms of guns, he refused to bring his own politics into Berkshire's operations. Most importantly, the meeting can serve as a much-needed reminder of the fundamental investing ideas and common sense that have made the Buffett and Munger partnership so successful. One often hears wisecracks from Munger such as this: "When there's nothing to do, Warren is skilled at doing nothing," says one Berkshire insider. Or consider Warren Buffett's take on what went wrong with the stagecoach. Wells Fargo is a corporation that has demonstrated the value of incentives. It's just that they were motivated in the wrong way. These can be overlooked throughout the course of a year as the market fluctuates. Saturdays might have something special going on as well. Buffett stated that he prefers to report earnings over the weekend so that investors can digest the facts rather than reacting to a barrage of news. Berkshire Hathaway's operating earnings increased by 49% to $5.3 billion in the first quarter, owing to improved insurance figures and the effect of recent tax cuts. However, due to the need to account for the dropping market value of its stock holdings, the company declared a net loss. Buffett's story about compounding, though, grabbed center stage. "You basically had to make one investment decision in your life," Buffett said of putting that $114 or $10,000 in the stock market in 1942. The most obvious and well-traveled path to wealth is to attach one's savings to the rising productivity of American business. "We've operated with the strongest tailwind in this country," Buffett stated. "You can't really fail at it," he says, "unless you buy the incorrect stock, try to time the market, or are enticed by a high-fee Wall Street product." Both Buffett and Munger see themselves as educators. They give the same basic advice year after year. Perhaps now is a better moment to pay attention than ever before. The stock market, which is reaching record highs, is uneasy. We've been in recovery for almost a decade. Unemployment is below 4%, and the Fed is raising interest rates to keep things cool. It's a climate in which proponents of getting out before a downturn are given more airtime, despite the fact that market timing doesn't work. Furthermore, despite Buffett's unmistakable evidence on the long-term value of equities, young investors are being enticed by hot new ideas like crypto, which are all the rage on college campuses, so much so that a question concerning cryptocurrencies was brought up during the Berkshire meeting. Is it a wise decision? Reuters transcribed Buffett and Munger's reaction as follows. their non-productive assets. Says the narrator, it will ultimately deliver nothing other than the illusion of scarcity. What does it create on its own? Whenever you buy non-productive assets, you're betting that someone else will buy them later. It does have a negative outcome. Cryptocurrency will have negative outcomes. For the next 100 years, Buffett made a big prediction at Forbes' 100th anniversary celebration in October. The Dow would reach $1 million level. It's a big headline, but it's based on reasonable assumptions. To reach $1 million, the Dow would have to compound at a pace of around 4% per year, which is less than half its rate of return over the previous century. Berkshire Hathaway shareholders are well aware of this. Berkshire's A shares will be worth $4 billion each in 2218 if they compound at 10% annually. Buffett's opening act on the long-term power of compound returns seemed to be the focus of Berkshire's annual shareholder meeting this year. However, attempting to time the market is extremely risky. As Buffett has repeatedly stated, you can predict what will happen in a great business, but you can't predict when it will happen. You don't want to concentrate on when. Instead, you want to concentrate on what. If you're right about what, you don't have to worry about when. Investors are frequently persuaded that they must try to time the market and begin investing when the market is rising and selling when the market reaches its high. Technical analysis, which involves analyzing stock movements and buying based on short-term, often arbitrary price variations, gets a lot of press, but it's no more effective than random chance. Do you find this video informative or helpful? Let us know in the comment section below. Make sure to receive future videos. Don't forget to like and share.